On today's show, we have Kent Ritter, and we're going to discuss multifamily syndication. Hello, Kent. Thanks for coming on today. Let's start by giving us some information about your background.
Sure, Joe. Thanks for having me. So my background, I started out as a management consultant and that was about 15 years ago now, and started out traveling around the country helping businesses solve their problems. So that's really what we did as management consultants, and spent 12 years doing that. 5 years of that 12 actually owned my own business with a few partners, our own management consulting business. And went through that typical kind of startup lifestyle of literally like 5 guys around a kitchen table, and grew that into a business as about 95 employees and just spent just right at 30 million in annual revenue, and decided to sell that business at the end of 2015. And that really kicked off my real estate career because I had the capital from selling that business and didn't want to have all my eggs in one basket, didn't want to be all in the stock market, riding that roller coaster. So decided to look into real estate. Well, I looked at a lot of other things, and real estate was really where I landed for a number of reasons. It spoke to me and checked all the boxes. And so started just educating myself, started investing passively in other people's syndications just to get some exposure, get the returns, but also start to learn what that's all about. Went through a few mentorship programs, listened to every podcast, read every book that I could. And for from the end of 15 to really into 19, that's really what I did, was just trying to learn as much as I could, knowing that I wanted this to be my next career, and really just fell in love with it, and fell in love with finding the deals and going through the process. And as I gained more experience and more confidence, I decided to go out and start actually running my own deals and finding my own properties and bringing in investors. And so in October 2019, led my first syndication with a group of partners, and then we've just been rinsing and repeating ever since. We did several deals in 2020 and another deal at the beginning of 2021. And now we've got two deals under contract right now. So we're working on our 7th syndication at this point.
So when you first heard about multifamily, was that through an online source? Was that people in your network, or how were you first, how did you find it?
Yeah, that's a good question. I think it started with a friend of mine. A friend of mine was investing through crowdfunding and really got me into that. The 2015, like crowdfunding was still pretty new. And so he got me into that, started looking at deals, started understanding kind of, what multifamily is and all the benefits. And then I really started with a lot of podcasts. So I started listening to a bunch of podcasts related to multifamily, started again, understanding it better, was able to kind of just skip that whole, kind of single family rental step and trying to amass a portfolio of single family rentals, and just went right to multifamily. I liked the scalability of it. I liked that, you could really approach it like a business. I liked that there was just better protection as far as, you could have, like in a lot of our deals, you could lose 25% of the residents on the property and still be able to pay the loan. And I like that aspect of it. And so, I think it started with a friend in crowdfunding, and then evolved from there in kind of more sophisticated ways as I built relationships with syndicators and people that were leading these types of deals and projects, and found some mentors, and then started doing it on my own.
So in that time frame, I guess between 15 and 19, did you participate in deals as a limited partner?
Yeah. So that was really what I was doing primarily in that time. And I was in 16. So I did my first investment in 15. That was on a crowdfunding site. And then in 16, I went out, found some sponsors, invested in 10 deals, and really deployed a lot of my capital into multifamily, and then continued to invest, in each successive year. But that was really a way that I felt like, one, I started out just thinking that I would passively invest, and thinking I would just take this money from selling that business and I would just passively invest. Well, I'm an entrepreneur at heart, and I can't sit still for that long. And I just really wanted to learn, kind of like my wife always tells me, like if I want to buy a TV, I'm gonna go look at like 40 TVs, and I'm gonna do like all the research and all this, and like figure out like the exact best one. And like, that's kind of how I am with everything. And so as I was investing in these deals, like I didn't want to just invest blindly and put my money out there. I wanted to know everything about them. And so I was asking a lot of questions. I was doing research, trying to learn more, like, how do you make good investments? How do you pick the right markets? What are the right markets? How do you pick the right deals? All this stuff. And I went through a couple of mentorship programs to learn a lot of that, and read a ton of books and just talked with a bunch of folks. And then as I just got into it more and more, I realized that, man, this is something I really think I can do on my own. I think I can take all that business experience I have and really create a business that will give me the lifestyle I want, also provide a ton of value for the people around me, allowing them to invest with me in deals that they typically wouldn't have access to. And it just was a lot of fun. And I just really enjoyed it, searching for the deals and doing the underwriting and going through the process. And so, yeah, it all just kind of went from something that was going to be very passive and just continued to kind of grow what I had to something that now has become a day-to-day business for me. And we're just growing the company and out there doing deals on our own.
Since more of our listener base would be probably considered an LP, I mean, I sure would like to hear some of the lessons you've learned. I mean, that's the best way from like the crowdfunding websites, right? What are some things that worked and maybe some things that didn't work?
Yeah, I had a really mixed experience on crowdfunding. So I did 2 deals on crowdfunding. One went fine. It was like a mezz debt type deal. So there was some additional, you're higher on the capital stack there, some additional security. The other deal that I invested in was just an equity, a common equity piece, just as an LP investor, and lost all my money in that deal.
All, not even a return part of capital or anything?
Like all of it. Yeah. The sponsor committed fraud. Ooh. And I mean, it wasn't just me, everybody lost their money in that deal. And so that was pretty gut wrenching. But the way I look at things is there's a lesson in everything that you do. And it didn't deter me. I mean, it wasn't real estate's fault. It wasn't multifamily's fault. Like the deal in itself was a good deal. It was just a bad guy. And so, the big thing I learned was shame on me. I didn't vet the sponsor. I mean, I went on the site and was scrolling through and was like, oh, there's a deal that looks good. Like I like that market, those returns look good, but I didn't know at that point really what to do. I didn't know what due diligence meant. And I didn't know that you should do due diligence on the actual sponsor, right? Like, I mean, you think like I was under the impression that the site was doing that type of diligence. Well, because that's what they advertise, but, essentially something got through and who knows, maybe even I wouldn't have found anything, but I didn't even take the step. And so a piece of advice would be, if you're going to invest with somebody and invest $50,000 or, whatever it is, that's a pretty standard minimum, at least make sure you're getting on the phone with that person and make sure you have a conversation with them. Make sure you're trying to look for what I've kind of boiled down to 4 things are what I look for. And, the first one is integrity. I mean, it starts there. It's like, if you're not investing with a good person, you're going to get taken like I did. I mean, there's people out there, unfortunately, that will do that. And so, it's hard to know, but you can at least get that gut check feeling, right? Is this a good person? Is this somebody that I would trust giving my money to? The next one is, they've got to have, I think a sponsor needs to have a decent amount of financial means themselves, because if a deal goes bad, you don't want the sponsor to be belly up and not be able to keep the deal going. I mean, I think it's the sponsor's responsibility to keep those deals afloat during bad times. And so they've got to have a certain amount of means to be able to do that. You also don't want a sponsor that's, just in it for the fees and is just trying to get the next deal done to get those fees, because those incentives aren't aligned, right? You want a sponsor that's trying to put you into the right deal, not just put you into the next deal because they want to get those fees off of it. So I think it's important that there's a certain financial means that exists to the sponsor. Other ones would be a track record. I look for people that have a track record, and I know everybody has to start somewhere. So it's not that you have to have had I talked with someone the other day and they set up a call with me and then they essentially said, well, I don't invest with anybody that hasn't had the same executive team in place for 5 years and isn't on at least their 10th deal. And I was like, okay, well, that's not me. So,
we're not a fit.
so what? Yeah. Why are we on the phone? But everybody has different criteria. I'm not quite that strict. I look at other things because I understand, just like me, everybody gets their start somewhere. Right. But I look for, if there's not real estate experience, then there's at least some sort of business experience. There's they've had some successes in their past where they've worked hard and been successful because of that. Right. And so I think there can be track record in many different ways, but there's got to be some track record there. And then lastly is just putting skin in the game. So, I want sponsors that are investing their money right alongside myself. It's something I do in all my investments just because it's kind of a simple thing. But if somebody came to me and said, hey man, you should really invest in this. And they're like, I'm not investing in it, but you really should. That's not something I would do. So I want to see somebody who's putting their money in right beside me. And so those are the 4 things that I really look for when I'm investing passively. And I still do invest passively, not in multifamily anymore, but in other asset classes like industrial or medical office where, I'm not the expert, but I want exposure to those areas. So those are the things that I really look for.
Well, let's hit a little bit on each one of those. So when it comes to the sponsor, how do you typically require a few references and then go and call them, or how do you vet that sponsor?
Yeah, it depends how well I know them up front. A lot of people that I invest with now, I've gotten to know over a period of time, but before I'm making that investment, or somebody that I know and trust has has been investing with them and has had success. And I've been able to see that. So yeah, I think it's important to build a relationship. I don't usually ask for references because, and references are a good source, but I just feel like people are going to give me their happiest people. Like they're never going to give me the people that were unhappy to be a reference, So it's, you can get I think references are good because people will ask me for references and I give them, but I also tell them, I think that references are good for you to help understand my style, my communication style, what you've experienced from when you're getting distributions, when you're getting communications, things like that. Have I delivered K1s on time? Like more of like the like practical things, I guess, or the concrete things versus, did you like the guy or whatever? So I think that the references can be good to kind of understand style. But I rely a lot on just getting to know somebody and having kind of that gut check. I mean, I believe a lot in intuition and in that gut feel. And I think that you can tell a lot from people, and that you should trust your gut.
Is there anything that you specifically implement to kind of nurture those leads as they first are introduced to yourself?
With other sponsors?
Well, not with yourself. I'm saying like if you guys have, let's say one of our listeners or potential LP approaches you, do you?
Oh, yeah.
I guess you have like a newsletter. Kind of how do you build your trust with those over time until they are actually ready to invest?
Yeah. The great question. So one is just my website. So a lot of people will start with the website. And so, I built the website in a way so people can get a sense of who I am, understand a little bit more about me and what I'm doing. Additionally, have my podcast, which is Ritter on Real Estate, which is exactly really built for a couple purposes. One is to allow people, again, to kind of get to know me and who I am and my personality. But two, it's to be a resource for folks that are passive investors. I mean, my podcast, like yours, is really targeted at people that are investing passively. And so I want to be giving back first, right? So that they get that feeling that I am trying to give back and help educate them as they come into the deals. So those are some starting points. And then we have a newsletter you can sign up for on the website. The newsletter goes out weekly. And so that's again, another way to continue to get to know me and my company and who I am. And then just the ability to fill out an application form and set up a call and get on the phone. And then, so I'll have folks usually from that first call, I suggest we have another call in 2 to 3 weeks, to continue to get to know each other and continue to progress the conversation. And I usually don't really get into a lot of the actual, like the first call, I just really want to understand who they are and their goals. And then I allow people to ask questions. And then as we have successive calls, kind of get into, what type of investments have you made? What are your targets? What type of investments do you like? More investment specific things. But yeah, there's definitely a process. And, some people come and they say, I've listened to 20 episodes of your podcast and I like who you are and I'm ready to invest. And other people say exactly that, I'm not quite comfortable yet. Want to kind of, see can you give me some example deals? Can I talk to some people, get some references, maybe just get on the newsletter. So people all start in different places. It depends on what their experience is, with different investments, what their timelines are, what their goals are, but try to make a process that kind of fits people wherever they're at and can ultimately get people to that level of comfort so that they feel comfortable making that investment decision. Because what I found is a lot of times it's not even because real estate investing, especially when your minimum investment, our minimum investment is $50,000. And so when you're investing a significant amount of money, there's definitely it's about getting comfortable with me, but for a lot of people too, it's just about getting comfortable with themselves and trusting themselves to make that type of investment, especially if they've never done it before. And so that's why through the newsletter and a lot of the education pieces I do, it's really to try to help people get comfortable feeling like they can make that decision. Because a lot of the first questions I get are like, these returns seem too good to be true. Like there has to be something that we're missing. And it's really, they're not too good to be true. It's just an unfamiliarity with what type of returns you can get from real estate investing. Because a lot of people are used to just the stock market or bonds or whatever, So it's like getting people comfortable with themselves to be able to believe that those returns are there and evaluate the deal and feel comfortable making that significant investment.
Yeah, people are used to handing their money over to advisors on the take a 1% fee and not quite sure actually what their annualized return is until they look at it down the road at some point, right?
Right.
So you mentioned skin in the game from the sponsor. What is your take? What is your take on the acceptable percentage of the amount to be raised that you like to look for?
Yeah, that's a good question. I don't really have a percentage. I look at it more as, I want them to have at least the minimum investment in, right? And that's what I always seek to invest in is the minimum investment. And based on my cash flow position, I may invest more depending on kind of what's going in and out at any given time. But it's having something there and something that's not just not just all acquisition fee as well. I mean, part of it can be funded from the acquisition fee. Like I get that as a sponsor. It's part of why we do these deals. But some of it has to be cash out of their pocket. So those are my main criteria. Because again, everybody starts in different places. Everybody has different financial positions, and not everybody's super wealthy when they get started off. But I want to know that at least what they're putting in is a meaningful amount for them, I guess, not necessarily a specific percentage.
A meaningful amount that they pay attention to the deal and are managing it to execute the business plan.
Exactly. Like if they're worth, $20 million and they're putting 25K in, like that's not a meaningful amount, right? But if it's their first couple deals and, they're trying to build up their own financial position, 25K could be meaningful for them. So it's more about, is that amount meaningful to the sponsor?
Thanks. And now when it comes to the fees, you mentioned acquisition fee. What's a normal acquisition fee LPs can expect a GP to take? And typically, what does that cover or pay for?
Yeah, that's a good question. So an acquisition fee, typically it would be between anywhere from 1.5% to 3%. There's probably 2 to 3% is the most common. But as deal sizes go up, typically acquisition fees come down. So on larger deals, $50 million deals, you may see 1%, 1.5%. But 2 to 3 is pretty typical. I've seen some higher. I've seen some lower. What they typically cover is really it's the fee to the sponsor for all the work that they've done to get to that point. I mean, it's a hard process, and it's paying for that deal, but also for the for the 50 deals that didn't happen and the time spent to find that one deal. So it's really the way that, to kind of reimburse the sponsors for their time and effort on the front end of finding the deal, putting the deal together, securing the financing, paying all the legal fees and doing all that piece of it that's required, and doing the due diligence and bringing all the pieces together that it takes to go and acquire a large apartment.
Well, let's go into details there, because this is definitely a very competitive market, and sourcing deals is, I'm sure, taking quite a bit of time to find the right one. And so why don't you kind of give us some insights into the steps that you're taking to source, and what locations are you looking at?
Sure. So sourcing deals, really, we have two primary strategies. One is going direct to seller. Through mailer campaigns and direct outreach to owners. And the other is through broker relationships. And, creating good broker relationships is the most important piece of finding deals. Especially if you're looking for a larger multifamily, because in the larger multifamily space, almost everything is going to go through a broker, when it's time to sell. So, creating those relationships are really how you get in front of deals and how you compete in a very competitive market. And the idea is to create those relationships and stay top of mind so that you can be on that short list and kind of see those deals as they come out before they go to full market. Because many brokers, before they fully market a deal, will send just the raw details, like a rent roll and a T12, which is the profit and loss for the deal, out to a small group and say, hey, is anybody interested in this one, for people they know that can close deals, so that they don't have to spend the time and effort and cost of creating the marketing package and going through a big marketing spend on that. So getting in that short list, I think, is critical to be able to find deals and take deals down, where otherwise you're going to end up in situations where you're bidding against 10, 15, 20 other people in a fully marketed deal. And that's pretty tough to make deals pencil out in this environment.
I was going to say, if everybody's getting a similar offering with the T12 and offer memo, what makes one bid, a lot higher than another to win it? Is there something that they're making mistakes on, or is there something that they can do differently to execute the business plan?
Man, I think a lot of it comes down to, so a lot of it definitely comes down to your cost of capital, right? So if you are backed by a large financial institution that maybe only needs to get a 4% return on their $1 billion, right? Because they have so much money, they just have to deploy it, then you're going to be able to pay a lot more for a property and still meet those investors' return expectations than somebody that's expecting an 8% preferred return and a 15% IRR, right? So that's one, is what is your cost of capital, and how much can you then pay in regard to that, right? And some groups are going to be more competitive because their cost of capital is lower because they're backed by larger institutions rather than individual investors. From an actual underwriting standpoint, people do all kinds of stuff. Everybody says their underwriting is conservative, but everybody's definition of conservative is vastly different. Right? And so some groups may be underwriting that rent's going to grow 8% a year for the next 5 years, and they're projections are going to look much higher, and therefore they can pay a higher price, and probably win that deal. But you have to, as an investor, ask what's the likelihood that's actually going to play out, right? I think investors that only look at an IRR number or even a cash on cash number and don't look at the assumptions behind it are really setting themselves up for failure, because it's, there's this idea of a risk-adjusted return, right? And everything you should look at is a risk-adjusted return. And another way that can be said is like, what's the probability that return is actually going to happen, right? Like you could go and invest all your money in startups, and those startups some of those startups may go 10x, but the majority of those startups are going to go down to zero, right? And so you may hit a few home runs, but you're going to lose a lot of money too. The risk reward is completely different, right? It's a high risk, high reward. Whereas a multifamily syndication really is fairly decent reward for really a low risk. I mean, in many ways, we're buying businesses that have been there for 30 or 40 years, cash flowing, and we're just trying to help them create some additional cash flow, right? We're not buying properties that are distressed and that are empty and we have to fund them until we can get them leased up and cash flowing. And a lot of these properties we're buying are having cash flowing for a long time. So you're buying a cash flowing business and just helping it make a little more money. So I think from a risk standpoint, the risk is fairly low. But again, you just have to look at the assumptions. And, it goes back to why is one more competitive than the other? Well, because somebody might be assuming rent's going to grow 3%. And somebody else is assuming rent's going to grow 8%. And their models are going to look completely different. But at the end of the day, as an investor, it's like, which one is going to be right? Or which one is more likely to be right?
What class apartments and what size are you currently targeting?
So B and C class properties, which kind of sit right in the middle of, if you think about real estate asset classes, there's four. There's A, B, C, and D. So B and C sit right in the middle. D would be kind of really bad neighborhood, really distressed property, not something that I want to get involved in. A would be like the nicest, newest stuff downtown, right? B and C kind of sits in the middle, where my properties are primarily suburban properties, garden style apartments, and built pretty much 1970 or newer, and they're going to be really targeted at workforce housing. So folks that are making typically anywhere from about $40,000 to $65,000 a year from a median household income standpoint. A lot of long-term renters, people that rent by necessity versus choice, right? A lot of even lifetime renters. We really cater to that demographic. And it's a really solid renter pool. And the whole trick of it is just maintaining a level of affordability as you come in to make your improvements. That's something that we look at very closely as we look to acquire apartments, is like, how affordable is it for the people in that area, right? And we want to make sure that it's not only affordable now, but even after we come in and make our improvements and then raise the rent to fund those improvements, that it's still going to be affordable. And we're not going to be pricing people out of the market. And I think if you can do that, then you can, again, have a pretty safe investment and maintain a good level of conservatism.
With the current rise in rents through most areas, I mean, where do you think, how much further can rents go from affordability standpoint? Do you think there's a lot of room to grow, or do you think we're already have seen a lot of that rent growth the last few years?
I mean, I think it all depends on the market. Yep. I think it's too, you can't be that general, really. I think that one thing that you should look at, and one thing that we look at very closely, is what we call the rent to income ratio. And so in any acquisition that we're making, we look at what is the median household income of that area, like the 1 mile radius around that property. And what is the rent, right? And so what the rent to income ratio says is how much of somebody's monthly income are they spending on rent. And what HUD, the Housing and Urban Development, tells us is that anybody that's above 30% is considered rent burdened, meaning it's unsustainable for them to pay that much of their income in rent. So we look at that threshold and we make sure that we're well under that 30% mark. And so when we make acquisitions on the front end, we like to be in the kind of the low 20s up to mid 20s to know that we can come in and raise rent and still after that be well under that 30% threshold, and know that there's an affordability component for those people, and the people that live around that property or work around that property can afford to live at that property. So I think that's what you have to look really closely at. But I mean, it changes drastically by market, and in some markets, 30% is like impossible. Like if you look at markets like some of the coastal markets like New York, San Francisco, I mean, people will pay 50, 60% of their income in rent.
Yeah.
So for what we're looking at in the Midwest, being in those mid 20s is definitely achievable. And we feel good about that, meaning that people can by and large afford their rent. And that's why, like, even during COVID, I mean, we saw hardly a blip from people being able to pay rent, from, bad debt. We did see delinquencies creep up a little bit, meaning it took people a little longer in the month to pay their rent, but ultimately people were paying, and we still maintained about 95% collections. And so we felt really good about that. And I think it's because of the affordability of the properties and because of really that demographic that we're targeting.
Your geographic location that you guys are targeting is the Midwest currently?
Midwest, yeah, and primarily Indiana, Ohio, and Kentucky. I mean, we operate in states that are, landlord friendly, have low taxes, and they're easy states to do business in.
That's simple.
Yeah.
So let's go into some other, reasons why, people in limited partners should invest in these multifamily deals. What are some of the top reasons that, they see benefits for?
Yeah, well, I mean, I'll just give you my own reasons of why I started doing this, right? I mean, it's, first and foremost, when I was looking at it, and a lot of people are in the same position, most people have their whole nest egg within the stock market, right? And so first thing is just diversification. You don't want all your eggs in one basket, and multifamily investments or any type of real estate for the most part is non-correlated with the stock market, right? Meaning if the stock market drops, your real estate's not automatically going to drop too, right? You want things that are non-correlated and things that will do well when the other is not. So one is just diversification, right? So that was number one, non-correlated with the stock market. Two was the returns were just much higher. I mean, double, triple from what you'd experience in the stock market long term. Because a lot of people quote like 100-year averages for the stock market. And it's like, oh yeah, it returns 7% a year. It's like, yeah, if you look back to 1900, sure, but you're not accounting for taxes. So take another 1 or 2% off that, and really you're like 5 or 6%. And then if you look at time periods of like the year 2000 to 2010, your return in the stock market was zero if you invested in the S&P 500. So, you got to be careful with those things, but real estate returns were much better. There's also a cash flow component, which, you don't often get in stocks either. You can get dividend stocks, but still the cash flow is kind of minimal. So I love that there's a significant cash flow component of anywhere from being able to get, 7, 8, 10% a year, in cash distributions from the profits of the property. And the last one was the tax benefits, being able to get your share of the depreciation and offset your gains through through that depreciation, and ultimately avoid paying taxes on a lot of your gains, or at least defer the taxes down the road to the end of the investment and keep that money in your pocket, because it is true, it's not what you make, it's what you keep, right? And so the real estate has a lot of tax benefits. And the more that you get into it and the more that you start investing in multiple deals, the more that those start to compound.
Now, do people have the ability to invest in these syndications with their retirement funds?
They do. People do. You have to consider a few things, though. One of the big benefits I just talked about is tax advantages, right? Well, if you're investing out of your retirement fund, it's already tax advantage, so you don't have that additional benefit of having the additional tax advantage, right? The other thing you have to be aware of is something called a UBIT tax, which is an unrelated business income tax, and it's different for everybody. So you need to talk to your CPA. But essentially, if you're investing in something that has a substantial debt portion, which most syndications do, there could be an additional tax that you have to pay. Now, I've seen that to play out as maybe degrading the returns in maybe a percent or 1.5%. I mean, it may not be material on something that's returning 15, 16, 17%, but it is something that people should be aware of. I don't want anybody to be caught off guard about that. So there are some additional considerations if you're investing from your IRA. You also have to set up something like a self-directed IRA or a solo 401k or something so you're taking it out of the control of whoever your current custodian is, with your work or somebody that's limiting what you can invest in, right? Only to their things. And if you go to the self-directed route, it really opens up to be able to invest in just about anything with your retirement account. So it's something that's worthwhile looking into for folks, even if they don't invest in real estate, just having more control on what you can invest in.
I agree there. And one of the things that I've noticed is most sponsors never kind of have a conversation around that UBIT part through their retirement accounts when they're marketing.
No, that's why I try to bring it up. Yeah. Well, yeah. And again, I never want to surprise people.
Yep.
I never want people to be surprised. And so I think it's better to be upfront about it and just let people consider it for themselves rather than them be surprised on the back end and say, well, what the hell? You didn't tell me this tax was going to come. It's not exactly my job. I'm not the tax accountant, but I do want people to understand that there's just other considerations they need to make.
Now, a lot of the potential or existing investors out there in the market right now, or even over the last year or two, have felt maybe uneasy about where the market is, right? It's like we're either too hot or we're like in a major recession last year, right? Or, it's not like this consistent feel where people are like, okay, we're going to have this normal growth. How are you, kind of what's your feedback on that? And how are you underwriting what's going to maybe happen next few years when you're, underwriting these deals?
Yeah, this is a great question. Great question. And, I can't predict the future, but I have some pretty strong feelings about it, I guess. I've been looking for a lot of negative indicators to say like things are going to cool down and stuff has to stop, but I frankly haven't been able to find many. I'm hearing a ton of positive things, reading a ton of positive things. And to me, that makes me feel a little bit uneasy because I'm like, well, I want to know like the other side, but honestly, I've really come to this belief that we are in a very unique time right now where, so let me just, for context, when I first started, it was actually 2014 when I first started like digging into real estate, because I remember in 2014, people being like, we're at the top, this is it, can't go up anymore, like sell, sell, sell. And here we are 7 years later. And if you bought something in 2014, you could have thrown a dart at a wall and picked a property and you made money on it. So, so people have been saying that for 7 years that we're at the top. I don't think we're at the top because of a few things. One is the fact that, with all of the government subsidies that have happened through COVID, through unemployment, through just putting cash in people's pockets, through all the other programs. I mean, there's $9 trillion plus dollars that are floating around that weren't 12 months ago. And it's pretty wild. Just that extra money that's just floating around there, that money has to be put somewhere. Right. And so a lot of the large organizations, the investment companies are just sitting there with a ton of what they call dry powder, which is money on the sidelines, and they want to invest and their return expectations are lowering, like we talked about at the beginning, because they just need to deploy the capital. So there's more money chasing properties than ever before. I think that interest rates are low and we expect them to stay low for the foreseeable future. I mean, the Fed has said they're going to start raising interest rates in 2023. But they've also said for the first time in like 30 years that they're going to seek an average inflation rate of 2%, not a ceiling of 2%. So you understand the difference is that before it was a ceiling of 2%. And every time we started to sniff 2%, they would raise interest rates and make changes and and inflation would dive. So we haven't hit 2% inflation in like 30 years. And so now they're saying they're going to let it run at an average of 2%, which means, well, we have to go above 2%, right? So they're actually going to let inflation run a little bit more, which means they're not going to preemptively raise interest rates, which is going to keep rates low. So even though they've said in 2023, they're going to kind of start to ratchet things up, I mean, that depends how things look in 2023. And I think still relative to history, interest rates are at super low prices. Money is very cheap, and therefore people can pay more. And we're seeing that in the single family space too, right? People are paying more for houses because they're able to get super cheap loans. I mean, we refinanced our house like 2.75%. That's crazy. And so money, that's another reason is the money is just so cheap right now. Again, there's more money floating around. There's more competition for deals, meaning prices are going to go up. So what I believe is going to happen in the next 2 to 3 years is we're going to see a ton of asset inflation. I think all the properties that we own are going to continue to go up. I mean, in markets that I'm in, I've seen 30% inflation in the past like 6 to 9 months. Like it's been crazy how much things are priced at now in some of these markets. And does it make sense for me in some of those now? No, but I'm also limited by my historical mind of being like, man, I just paid for this 6 months ago. Like I can't pay 30% more 6 months later. And like, maybe that's true. Maybe that's not, but it's the fact of the matter is where things are. And I think we're going to continue to see that inflation. And so I think, and then I think you just have a general, like if you take it back to the biggest picture, you have like supply and demand. And the fact of the matter is that there's just not enough housing for people. There's not enough single family houses. I mean, I read a report that we were 4 million single family houses short. I read another report on multifamily saying we're anywhere from like 4 to 5 million multifamily units short. So, I mean, there's a significant housing shortage and construction has slowed. It's slowed through COVID where things are starting to pick up now, but it's being slowed by labor shortages and increased material costs, right? So as housing prices continue to increase, people are going to be pushed to rent for longer. So I think that from a rental, I'm very bullish on the rental space overall. I think that over the next couple of years, we're going to have kind of this perfect storm of cheap money, demand outpacing supply. And the only thing I think that there's two things I think that kind of get us off this this trajectory we're on, I think one would be interest rates rise drastically, but I don't see that happening into the future. I mean, they're going to go up, but I don't think they're going to go up in that meaningful of a way. And then two would be just oversupply, right? But we're so far behind that we would have to build, triple the pace we've been building for the past 10 years to hope to catch up in the next, I don't know, 5, 6, 7, even 10 years. So I don't really see that happening either. So I think that there's going to be this period of growth that becomes a little murkier as we get into the next presidential election. I definitely don't have a crystal ball, so all of this is just my opinion. But I think that we're in a unique time for asset appreciation and to create a ton of value by investing in real estate.
I think that you have to form some type of opinion, right? Because you got to kind of create your own pro forma and make a business plan and move forward with that. So I appreciate your feedback there. I guess, maybe what we've seen the last 5, 10 years or last 5 more than anything is it seemed like a lot of the outsized returns have been made more because of a compression of cap rates. And now we're kind of getting near, let's call it a floor somewhat in cap rates. Do you think this is more like a rent growth play that we're seeing here in the next few years?
I think that honestly, cap rates are continuing to compress. I mean, Indianapolis, where I'm at, is now a 4 cap market, which is something that we never thought. You have cities like Austin, where you have stuff selling in the two caps, like 2 8 caps. Same thing on the coast. So I don't know that we have seen a floor. There's got to be a floor, but I don't know that we've seen it yet. I think that longer term, the other thing are just, we talked about supply and demand, but like the demographic trends are what is pushing demand, right? You're having people renting for longer than ever before. You're having baby boomers who are downsizing into rentals. They don't want to have the maintenance of a house. You're seeing more people want to rent. I think if you look forward, you can look at countries like Germany. So Germany, there's, I think it's something like 70% of the population rents, where US is like in the 60s ish. And they've had 3 caps for years because their interest rates have been at 0 for years. And so I think if you look at a country like that, I think that's where you could see the US start to move in all reality. And so I think cap rates likely do compress some more. I mean, they have to hit a floor eventually, but I do think we see some more compression. I think if nothing else, over the next couple of years, we probably see stability in cap rates, where I think a lot of people like I am are still underwriting for cap rates to expand. And so, the hope is that if they do expand, we underwrite that way so that if they expand and the cap rates go up, well, we're going to be on target for what our returns are. But if they don't, that's gravy on top of the deal, and we can underpromise and overdeliver, right? So I think where you asked the question earlier about why can some people pay a higher price? Well, a lot of it comes down to those cap rate expectations. And are people underwriting cap rates expanding, staying flat, or even compressing in their model? And I wouldn't, I would be hesitant to invest in a model where I saw cap rates actually decreasing over time, just because if they don't, then you're not going to hit what you're being told you should be able to hit. And so there's not much margin for error there. I'd rather see a little bit of a lower return, but a higher likelihood of achieving it. Right. But to your question. So one, I do think cap rates probably stay flat or continue to compress over the next at least 2 years. And then from a rent growth standpoint, I think we're in a couple of years where rent growth is going to continue to grow pretty rapidly. Just because I think as housing prices increase and everything that we talked about, just lack of supply, there's just not a lot of other options or places for folks to go.
Well, I appreciate that. Is there anything else you kind of want to add to our conversation today?
No, I think we got into a ton of detail, probably a little more detail than I usually am, but I appreciated the questions. I mean, it's a lot of things I spend a ton of time thinking about. So what's going to happen in the future, and and how's that going to affect things, and how are we underwriting, and how are we putting deals together? I think one thing you mentioned, like, how has it changed our approach? I mean, we're still underwriting cap rates to expand, not as much in all markets, especially if we're buying above where market cap rates are by maybe going to a direct to seller, for example. I'm not going to say they're going to continue to expand way above the market, but, but we're still ultimately kind of trying to add in some conservatism into those cap rates. From a debt perspective, we've moved to, we were doing a lot of 10-year fixed debt, but because of the cycle, we've actually decreased a lot of our hold times down to like 3 years versus a traditional 5 years. And with that shorter hold time, it's caused us to look at debt differently, because you need the right debt paired with your hold time because you have to consider things like prepayment penalties. So we've looked at, if it's a 3-year hold, then maybe more like a 5 to 7 year fixed debt than a 10-year fixed debt, just to balance the stability with the prepayment penalties. But oftentimes on our deals, we will pay a little bit more upfront in the interest rate to have a more flexible prepayment. So instead of doing like a yield maintenance, which can really hit you with extreme penalties if you sell early, more of like a step down prepayment where we're locking into, okay, in years 1 to 3, it's a 3% prepayment penalty. Years, 4 and 5, it's a 2%. In years like 6 and 7, it's a 1%, for example. So we know what those prepayment penalties are, and we can forecast those, and we're just creating that flexibility to allow us to sell at the right time and not be able to sell into the right market just because we're facing high prepayment penalties. Because a lot of people are stuck there right now in this market where it's a seller's market. It'd be a great time to sell your property, but the prepayment penalties are too punitive right now to be able to sell the property. And so folks are being caused to hold on.
Well, I appreciate that. And so I guess to wrap up, we always have a final question, and that is, what is the biggest thing that you have implemented in your life that has helped increase your net worth?
Man, that's a really good question. The biggest thing I've implemented in my life. I think it's building a team around me. I started out trying to do a lot on my own, and whether it was my podcast, which I edited myself for like the first 6 months, and man, that takes 10 times as long as you think it's going to take. Like, that's not an easy thing to do. All those things take away from your kind of highest and best use, right? So I think it would be getting really clear on what my highest and best use is, which are really two things. One is creating relationships with investors. And helping investors through the investment process. And 2 is creating relationships with brokers. Those are the 2 things that I try to spend the majority of my time on. And everything else, I've tried to very intentionally outsource by creating a team around me to do that, so that I can focus on what's going to create the most value for me and my company and my family. And so I think that has had a pretty big impact in my life. Really, I mean, for a while, but especially over the last years, I've been really intentional about doing it. And my word for the year this year was intentional. So in everything that I'm doing, I'm trying to be just that, very intentional in doing it and spending my time in a very intentional way. And I've definitely seen benefits to my net worth from spending time on the right things and being able to let go of the other things.
It's definitely something I've heard before, and getting the right teammates. And maybe for those that are listening that are thinking the same thing, but maybe they're struggling to find those right teammates or those right outsourcing companies that actually have the best expertise to bring on their team. Maybe what are some things that you've used to filter to get those right people or implemented? Yeah,
that's a good question. So depending on kind of the tasks to be done or the level, we'll determine if I go to like an agent. So everybody that I have on my team is a contractor at this point. And a lot of them have been found virtually. Some are local, but a lot of them have been found virtually. So virtual assistants of some sort. If it's just a specific task that I need done, I'll go to like an Upwork or a Fiverr and find someone. Like if I need a PDF copied into Excel or something, right? Like you can go to Fiverr or Upwork and find somebody to do that for $3 to $5 an hour. And they'll do a good job. If it's something that's more long-term, then I like to work with agencies because I just have that kind of continuity of if I need to move people in and out, if they quit, and I feel like there's somebody else to hold it accountable as well. So yeah, I've used several agencies, but like the way my team looks now is I have like an operations coordinator who's kind of my executive assistant plus, like, she started out as really my assistant and has grown to do a lot more for our business. The easiest way to describe her is she kind of owns all the work plans and makes sure that we are staying on time and staying on task and everything's getting done that needs to get done. She it works as a central hub. I'll even have her join calls with me and just take notes so that we have notes after the calls, and she sends those notes out. And it's a great way to hold people accountable, right? Because people say they're going to do things, and if it doesn't actually get written down and followed up on, then oftentimes that stuff just goes by the wayside. So that's been a really good tactic. I have an underwriter who I use, who again is a contractor, and he does all my first pass underwriting to get the deals to the point where I can take a look at them and make a decision. And then I've got several other folks like on the marketing side. Like I have somebody who edits my podcast, somebody who helps market my podcast and advertises and helps book, and someone who manages my newsletter. Just a number of folks who now help me get all these things done so I can do more in a day than just one person.
I feel like that is the way of today, is at least at launch and starting, and as you scale, is to bring as many professionals in that bring the expertise in and get out there and start doing deals until maybe you hit a scale that you keep building your internal team more.
Yeah. And I mean, I love working with contractors. It's just a really easy way to get people onboarded and up and running. You don't have to worry about payroll and all those things that come with that. And yeah, it's a really easy way to scale quickly. I mean, in our consulting business, like I said, we had 95 employees, and And there was a lot of employee management, a lot of HR. I mean, managing people is not my favorite thing to do. I'd rather have a small team of really highly skilled people than a big team of kind of lower quality. And so I try to keep it small, lean and mean, right? And yeah, using contractors has been a really good way to do that and scale up and down as needed and try new things too, without really having to spend. I mean, hiring and firing are two of the biggest expenses you will have in a business. And so if you can do it through contractors, it really helps limit those costs, increase your flexibility.
Appreciate that. So for all of our listeners that would like to get a hold of you, where is the best way to do that? Yeah,
the best way to do that is at my website, kentritter.com. And the second best way to do that is to listen to my podcast, which at the end, I'll tell you to go to my website. And so if you go to the website, there's just really, you can access everything from there. There's a blog. We do a blog. It's weekly or even a couple times a week. You can see the podcast there. We're starting to do more video content that we have up there. And then you can read my story. And there's also an area for passive investors with terms and frequently asked questions and things just to familiarize yourself with these type of investments. Because like I said, they can be a little daunting your first time going in. So try to make it easy on folks.
Well, I appreciate coming out today and sharing all that information.
Yeah, thanks, Joe. Appreciate having me on the show. It's been a lot of fun.
Thank you.
Have a good one.
Hey, everyone. Thanks for watching my latest interview. If you like what you saw, please click the subscribe button below to become a member of the Joe Robert community. Be sure to hit the bell to turn on all notifications so you always know when I post a new video. Tell me what you thought about the content in the comments below. I always read them and would love to answer any of your questions.